Welcome to Tech Money Madness, your daily U.S. stock market podcast. Today is April 30th, 2026, and I am looking at a stack of sources today that, frankly, make absolutely no sense when you put them next to each other.
Yeah, they really don't.
Right. I mean, we've got the latest macro GDP data,
Mhm.
a fresh batch of geopolitical briefings, the newest Fed policy notes, and a mountain of Q1 corporate earnings. And if you read these sources in isolation, you would swear they were describing two completely different planets.
It's a profound disconnect.
Yeah.
And, for you as an investor, or really just someone trying to understand the economy, the stakes of figuring this out are incredibly high right now.
Which is exactly our mission for this deep dive.
Exactly. We are looking at a system that is stretched to its absolute physical and digital limits. I mean, on one hand, you have the digital economy posting just staggering record-breaking numbers.
Oh, absolutely.
But then on the physical side, the actual tangible economy is bogging down in sticky inflation, slowing growth, and, well, major global conflict.
Which brings me to the massive contradiction right at the center of my desk. The S&P 500 is currently heading for its best month since 2020.
Wow.
Yeah, that implies roaring success. But beneath that shiny headline, the actual macroeconomic data is just throwing up red flags everywhere. Let's start with the broader economic reality before we look at the stock market itself.
Good idea.
So we got the first quarter U.S. GDP numbers, and the economy only grew at a 2% rate. Now, I know 2% isn't a recession, but compared to the expectations we had going into the year, it feels like we're just walking through mud.
Walking through mud is a highly accurate way to visualize it, honestly.
Yeah.
2% growth indicates that the velocity of money, how fast dollars are changing hands, how quickly businesses are expanding, it's all decelerating.
Right.
In a robust economy, especially one with this much capital sloshing around from the last few years, you really want to see a much higher GDP expansion. When it drops to 2%, it means corporations are holding off on building new facilities. Consumers are thinking twice about major purchases.
This overall engine is just losing RPMs.
Exactly.
But usually if the economy slows down, prices slow down with it, right? I mean, demand drops, so prices drop, but that isn't happening. Core inflation hit 3.2% in March.
Yeah, it's stubborn.
Very. So growth is slowing, but the cost of living is still climbing. What is the mechanism keeping those prices artificially high when demand is softening?
It really comes down to friction in the physical world, specifically supply chain challenges and energy costs driven by geopolitics. If we look at the energy markets, Brent crude oil recently spiked to a staggering $126 per barrel.
126.
Yeah. And that wasn't driven by consumer demand. It was driven entirely by fears of escalation in the ongoing war involving Iran. It has pulled back slightly since that peak, but the damage of a spike like that ripples outward immediately.
Stop there for a second because I want to make sure we connect the dots for the listener here. How does a temporary spike in oil in the Middle East lock in a 3.2% inflation rate for someone, say, buying groceries in the Midwest?
Because oil is the hidden tax on absolutely everything physical.
Right.
If crude oil spikes, diesel fuel spikes.
Makes sense.
That means the cargo ship bringing raw materials costs more to operate. The freight train moving goods from the port costs more. The 18-wheeler delivering inventory to your local supermarket costs more.
So it compounds.
Exactly. By the time a product reaches a shelf, the manufacturers had to absorb 3 different energy price hikes, and they pass that premium directly to you. That physical friction is what keeps the inflation number stubbornly stuck at 3.2%, regardless of domestic demand.
And speaking of that geopolitical friction, the U.S. and Iran are locked in this escalating standoff. We are currently watching a critical 60-day deadline tick down for congressional authorization for the war.
Right.
Now, entirely stripping away the politics of that situation, purely from a market mechanics standpoint, how does a 60-day legislative timer impact corporate behavior?
Well, markets can price in good news and they can price in bad news. What they cannot price in is uncertainty.
Yeah. The unknown.
Exactly. When institutional investors and multinational corporations look at a 60-day legislative clock on a major global conflict, their forecasting models just break. If you are a logistics company, how do you project your third quarter fuel costs?
You can't.
Right.
Yeah.
Do you route your cargo ships through riskier, cheaper straits, or do you take the long, expensive way around? Because nobody knows what will happen on day 61, corporate treasurers freeze. They stop spending. They hoard cash.
It's a massive variable that paralyzes the forward momentum.
It really is.
So we have international uncertainty causing paralysis, and at the exact same time, we have domestic policy shifts restricting liquidity here at home. The Trump administration just finalized new federal student loan caps.
Yes, they did.
And looking at the documents, they have kept a very narrow definition of which professional degrees are actually subject to the higher annual and lifetime graduate loan limits. Again, putting all the social debate completely aside, what is the mechanical economic impact of capping student borrowing?
Right. Mechanically, it is a direct reduction of immediate liquidity entering the economy. Think about how a student loan functions in the ecosystem. The government issues the debt, the student borrows it, but that money doesn't just sit in a vault.
Right, it goes straight to the school.
Exactly. It is immediately transferred to a university. The university uses it to pay salaries, fund construction projects, buy technology, and the student also spends living expenses in the local college town.
So it's a localized economic engine.
Yes. And by strictly capping those loan limits and narrowing the professional degree exemptions, you are turning off a massive faucet of cash. While it reduces long-term debt burdens for the borrower, in the short term, it sucks localized spending power right out of the system.
Another subtle way the overall economy is being cooled down.
Precisely.
Which brings us to the ultimate cooling mechanism, the Federal Reserve. We have 2% growth, which is sluggish. We have 3.2% inflation, which is too hot. And in response, the Fed has decided to maintain interest rates at 3.50% to 3.75%.
A very hawkish stance.
Yeah, they are keeping a hawkish stance and have officially wiped out any expectations for rate cuts this year. Why can't they just cut rates to stimulate that 2% growth back up to a healthy level?
Because they are trapped by their own dual mandate. The Fed's job is to maximize employment and keep prices stable. Normally, if growth drops to 2%, they would lower interest rates.
Right, to make borrowing cheaper.
Exactly. Lower rates mean cheaper corporate loans, so companies hire more, build more, and growth goes up. But if they lower rates now, they inject more cheap money into an economy that is already struggling with 3.2% inflation.
Oh, I see.
They would be pouring gasoline on the inflation fire. So they just have to keep rates high to suffocate the inflation, even if it means suffocating economic growth in the process.
Okay, let me try an analogy here because I think I'm seeing the trap. It's like we are flying a commercial airliner. The 2% growth means our airspeed is dropping and we're losing altitude.
Okay, I like this.
The normal reaction for a pilot losing airspeed is to push the throttle forward and dump more fuel into the engines. But inflation means there's literally a fire in the engine.
Yes.
If the Fed pushes the throttle, if they cut rates, they feed the fire and the engine explodes. So they just have to sit on their hands, keep the throttle pulled back, and let the plane descend.
That is a phenomenal way to visualize it. The Fed is perfectly aware the plane is losing altitude, but putting out the inflation fire is their absolute priority. And in any normal historical period, if you combine high borrowing rates, 3.2% inflation, $126 oil, and the threat of war,
The stock market would be in a total nosedive.
it would be a bloodbath.
But it isn't. The S&P 500 is having its best month in years, and this is the paradox we set out to untangle. How is the market gaining altitude while the economic engines are practically failing?
Because there is a secondary engine attached to this market that is generating so much thrust, it is overpowering the drag of the entire physical economy.
And that engine is the artificial intelligence boom.
Without a doubt.
Let's dive into the tech sector then, because it is essentially carrying the entire market on its back. The numbers in these source documents are almost difficult to comprehend.
They really are staggering.
I'm looking at a projection stating that big tech capital expenditures CapEx will top $1 trillion by 2027. $1 trillion. With a T.
It's a massive number.
I need you to explain the physical reality of this to me. Where does $1 trillion actually go? Is this just an arms race built on boardroom hype, or is there physical infrastructure actually being built?
It is an arms race, yes, but it is a very physical, very real one. When we talk about $1 trillion in capital expenditure by 2027, we are not talking about software development or marketing budgets.
What are we talking about then?
We are talking about concrete, copper, and silicon. Big tech is buying up massive tracts of land. They are building sprawling, multi-acre data centers.
Wow.
They are installing industrial cooling systems that require millions of gallons of water, and they are upgrading local power grids just to handle the electricity these server farms require. They are building the physical factories of the 21st century.
And what exactly are these factories producing? Because, when a regular person uses AI, they just open a browser and type a question into a chat box.
They are producing compute power specifically through the cloud. This is why we saw Google Cloud, Microsoft Azure, and Amazon Web Services all report better than expected results this quarter.
Ah, okay.
Think of cloud computing as the foundational plumbing for the entire AI revolution. If a major healthcare company wants to build a proprietary AI to analyze X-rays, they do not have the time or the billions of dollars required to build their own data center.
So they just rent it.
Exactly. They run computing power from Amazon or Microsoft.
So the massive revenue growth in the cloud sector is really the proof of concept here. It proves that businesses aren't just putting AI in their press releases. They are actively signing contracts and paying for the raw computing power to run these models.
Exactly. It's the most undeniable signal of demand we have. The cloud providers are selling the picks and shovels for the AI gold rush, and they are making an absolute fortune doing it.
And that demand requires actual hardware, which brings us to the semiconductor sector. Let's talk about Intel.
Oh yeah, Intel's had a wild ride.
Intel's stock more than doubled in April. A legacy tech company doubling its market cap in 30 days is just wild. This was off the back of a blowout earnings report and deep optimism about their revival. How does Intel fit into this trillion-dollar capex clumbing?
Well, Intel is the ultimate layer of the physical infrastructure. Before Microsoft can rent out a cloud server, they have to build it. And to build it, they need advanced microchips. For a long time, Intel was viewed as a laggard. They were struggling with manufacturing delays, losing ground to competitors. But the sheer volume of this $1 trillion spending spree is so gargantuan that it is lifting the entire semiconductor supply chain.
A rising tide lifts all boats.
Exactly. Intel's blowout earnings prove that there is so much demand for silicon that the market is pulling every available chip maker into the stratosphere. It is a massive turnaround story for them.
But I'm looking at this week's specific earnings reports, and the market is starting to get extremely picky. Investors are starting to ask really tough questions about this trillion-dollar price tag.
Yes, the honeymoon phase is over.
We're entering what looks like a show-me-the-money phase of this earnings season. Let's look at the actual winners and losers, because it is not as simple as AI means stock goes up anymore.
No, it isn't.
Yeah.
We've transitioned from the hype phase to the severe scrutiny phase. Investors are no longer just looking at top-line revenue. They are forensically examining the balance sheets to see exactly how these CapEx investments are affecting profit margins today.
Which explains the biggest mystery in my stack of papers today. Microsoft.
Yeah, that was fascinating.
Microsoft reported their earnings. They beat Wall Street's estimates. Their cloud division is booming. Technically, they won the quarter. But the stock dropped 5%. Why is the market punishing a company that just delivered a beat?
This is the core tension of the entire tech market right now. Microsoft didn't drop because their software isn't selling. They dropped because of intense investor anxiety over their exposure to OpenAI and their massive CapEx outlook.
Ah, the trillion-dollar build-out.
Exactly. That money hits the balance sheet today. When Microsoft tells investors, hey, we had a great quarter, but we are going to need to spend unprecedented tens of billions of dollars over the next 3 years building dedicated data centers for OpenAI, Wall Street gets nervous.
Because it's a cash flow problem. The investors are saying, you're spending $50 billion on copper and cooling towers right now, but when do the profits from that specific investment actually show up?
Precisely. To use an analogy, it's like Microsoft is building the most advanced high-speed rail network on the planet. They've laid the tracks, the trains are beautiful, and they assure everyone it will revolutionize transport.
What?
But the investors are standing on an empty platform looking at the multi-billion-dollar construction bill, asking, when do the ticket sales actually start paying for the steel?
And Meta faced the exact same punishment, right?
Yes. Meta was one of the top losers this week, dropping 8%. They are spending so heavily on future AI infrastructure that investors are balking at the price tag. The market is demanding near-term profitability, not just long-term promises.
But then you look at a company like Apple, and the story is entirely different. Apple reported massive 17% revenue growth, entirely topping estimates.
Huge quarter for them.
And what is fascinating to me is that this growth wasn't driven by selling more iPhones. It was entirely driven by its services business. The App Store, iCloud subscriptions, Apple Music. The stock had gone nowhere for 6 months, but now it's one of the most active stocks on the board. Why is Apple thriving while Microsoft gets punished for spending?
Because Apple is in the business of taxing an ecosystem they already built. They have over a billion active devices in the hands of consumers. When you buy cloud storage or an app, that is incredibly high-margin recurring revenue.
So no new massive infrastructure needed.
Right. Apple does not need to build $1 trillion worth of new speculative data centers to capture that money. They just flip a switch on the software side. Investors love services revenue because it's safe, predictable, and doesn't require massive capex drains.
That makes total sense. You also saw Alphabet, Google's parent company, jump after beating Q1 expectations. But the really notable thing there was that they raised their quarterly dividend.
That was a huge signal.
And Amazon rose on upbeat Q1 results that blew past revenue guidance. It seems like the market is saying, we will tolerate your AI spending, but you have to throw us some cash right now to keep us happy, which Alphabet did with a dividend.
Exactly. Alphabet essentially bribed investors for their patience. They proved they could balance the massive capital required to build AI while simultaneously returning tangible cash to shareholders today. It's a very delicate tightrope walk, and Alphabet executed it perfectly.
While the giants are walking tightropes, I want to talk about the underdogs because there was some incredible movement this month that really caught me off guard.
Let's hear it.
Reddit saw a massive 69% jump in revenue, completely crushing estimates. Other top gainers included Blue Owl up 10% and Rivian up 5%. But I want to focus on Reddit, a 69% revenue jump for a message board site.
It sounds crazy, I know.
How does a platform famous for memes and arguments suddenly become an absolute juggernaut in the middle of an AI boom?
It goes right back to the foundational mechanics of how artificial intelligence actually learns. An AI model, like a large language model, does not intrinsically know how to speak or reason. It has to be trained.
With data.
Right. And to train it, you have to feed it billions and billions of parameters of human syntax, context, sarcasm, and debate. You need raw conversational data.
And Reddit is essentially the largest organized archive of human conversation on the internet.
Exactly. For years, people viewed Reddit as just a community forum. But in the era of AI, Reddit realized they are sitting on a goldmine of training data. They have begun aggressively licensing their data archives to major AI companies.
Wow.
They were selling the raw material that makes the AI sound human. That 69% revenue jump is the market realizing that Reddit isn't just a social media underdog. They are a critical supplier to the trillion-dollar AI machine.
Wow. Okay, so what does this all mean for you listening? Let's bring all these disparate sources together. What this deep dive reveals is a deeply, stubbornly bifurcated market. It is split right down the middle into two distinct realities. On one side, we have the physical economy. This is the world dealing with 3.2% inflation, tight liquidity from federal loan caps, high interest rates acting as a brake on growth, and a global supply chain vulnerable to the geopolitical shock of 122.6 barrel of oil.
It is heavy, it is slow, and it is expensive.
Exactly. And operating in parallel is the digital economy, a world where tech giants are casually budgeting $1 trillion to build the infrastructure of the future, where cloud computing is growing at breakneck speed, companies are posting double-digit revenue jumps, and even social media forums are monetizing their text into AI gold.
It's two completely different universes.
Which leaves us looking at an S&P 500 that is charting its best month since 2020 because the immense gravity of the physical world is currently being overpowered by the thrust of the digital one. But it does leave me wondering about the long-term sustainability of this dynamic.
It leads to a critical and perhaps uncomfortable question we all have to consider. We have established that the AI boom requires $1 trillion of physical infrastructure power grids, cooling systems, raw materials.
Right.
But we have also established that the physical economy is constrained by 126 oil, geopolitical war, and restrictive Fed policy.
Right.
So are we heading toward a massive collision where the digital economy's insatiable demand for physical energy outstrips the real world's capacity to provide it?
That's a scary thought.
If inflation and oil prices remain sticky, does the physical reality of the energy grid eventually become the hard cap on the AI revolution?
It is a terrifying and fascinating tension to watch unfold. Will the energy limitations of the real world choke out the digital boom, or will the massive productivity gains of AI figure out a way to solve our physical constraints? That is the billion-dollar question. Thank you for joining us on this deep dive. Keep questioning the numbers, buying the headlines, watch those CapEx margins closely, and that's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.